Here's what Wall Street doesn't want you to know. While everyone's panicking about falling oil prices, ConocoPhillips just pulled off a masterclass in strategic maneuvering that left analysts scrambling to revise their predictions. On Thursday, the energy giant dropped a bombshell announcement that sent shockwaves through the industry. The company revealed it's offloading its Anadarko Basin assets for a whopping $1.3 billion. But here's where it gets controversial. This move is part of a much larger chess game that most investors completely missed. Let's break this down in simple terms. ConocoPhillips didn't just stumble into success, they orchestrated it. The Houston-based oil major simultaneously crushed second-quarter profit expectations, delivering $1.42 per share versus the anticipated $1.38. But that's just the tip of the iceberg. The real story? This Anadarko sale represents something far more strategic than a simple asset divestiture. ConocoPhillips is essentially reshaping its entire portfolio following its massive $22.5 billion acquisition of Marathon Oil, a deal that many critics initially called overpriced and risky. The company took on approximately $5.4 billion in debt through that acquisition, and now they're proving the doubters wrong with surgical precision. And this is the part most people miss. ConocoPhillips has already surpassed its original $2 billion asset sale target ahead of schedule. The company boldly raised the bar, setting a new goal of $5 billion in asset sales by 2026. This isn't just about paying down debt. It's about unlocking an estimated $1 billion in cost savings and margin improvements. But here's where the strategy gets really interesting. While competitors struggle with declining oil prices, Brent crude averaged nearly 20% lower in the second quarter compared to the previous year. ConocoPhillips cushioned the blow through explosive production growth. Their output surged to 2.39 million barrels of oil equivalent per day, BOEPD, in the second quarter, representing a massive 446,000 BOEPD increase year over year. For those unfamiliar with oil industry metrics, think of barrels of oil equivalent per day. That's the industry's way of measuring total energy production, combining both oil and natural gas output into a single comparable figure. This dramatic production boost came directly from the Marathon Oil integration, proving that sometimes the biggest risks yield the biggest rewards. The company projects third-quarter production between 2.33 million and 2.37 million BOEPD, maintaining robust output levels despite market turbulence. CEO Ryan Lance acknowledged that global oil markets remain choppy in the near term, but made a bold prediction that's raising eyebrows across the industry. Lance expressed strong optimism about natural gas prospects, citing surging global liquefied natural gas (LNG) demand. This bullish stance on gas comes at a time when many energy executives are hedging their bets, but ConocoPhillips is doubling down on what they see as the future of energy. The numbers tell a compelling story. Despite oil prices taking a significant hit, with ConocoPhillips' average realized prices falling 19% to $45.77 per barrel oil equivalent, the company's production strategy more than compensated for the revenue decline. This performance prompted RBC Capital Markets analyst Scott Hanold to label the results strong, specifically praising higher output, reduced costs, and the company's ambitious cost-cutting plan exceeding $1 billion. The market responded favorably, with ConocoPhillips shares climbing over 1% following the earnings announcement. Hanold expects continued outperformance as the update addresses previous cash flow concerns that had been weighing on investor sentiment. The Anadarko asset sale, facilitated by Haynes Boone and involving Oklahoma-based Flywheel Energy, backed by Stone Ridge Energy, represents more than a simple transaction. It's part of ConocoPhillips' broader strategy to shed non-core acreage while focusing resources on higher-margin basins that deliver superior returns. The company projects generating over $7 billion in incremental free cash flow by 2029. A forecast that, if accurate, would position ConocoPhillips as one of the most cash-generative companies in the energy sector. But let's address the elephant in the room. Is this aggressive asset-selling strategy sustainable? Or is ConocoPhillips essentially selling the family silver to maintain short-term profitability? The company has already disposed of assets worth more than $1 billion since the Marathon deal closed in November, raising questions about long-term growth prospects. Geopolitical factors continue adding complexity to the oil market equation. Prices briefly spiked above $80 per barrel in June, following Israeli strikes on Iranian nuclear facilities, but subsequently retreated to approximately $67 by quarter's end as demand concerns and diminishing risk premiums took precedence. U.S. import tariffs, weak global economic indicators, and increased OPEC Plus production have all contributed to price volatility. Here's the controversial question that's dividing industry experts. Is ConocoPhillips' strategy of aggressive asset sales and production growth truly visionary? Or are they simply benefiting from fortunate timing while potentially mortgaging their future? Some analysts argue that selling assets during a period of lower oil prices might be premature, that the company could potentially realize higher values by waiting for market recovery. Others contend that ConocoPhillips is demonstrating exceptional capital discipline by monetizing non-core assets while they still command premium valuations. What's your take on this strategy? Do you think ConocoPhillips is making brilliant long-term moves, or are they potentially sacrificing future growth for short-term financial engineering? The company's bold predictions about natural gas demand and their confidence in generating massive free cash flows certainly paint an optimistic picture. But in an industry known for boom and bust cycles, is this confidence justified or dangerously over-optimistic? Share your thoughts. Are energy companies like ConocoPhillips finally adapting to a new reality? Or are we witnessing another example of corporate short-termism that could backfire when market conditions change?